This is an audio recording of the Lendit Fintech Weekly News Show. The show is streamed live on Lendit TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the Lendit News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody, and welcome to the Fintech Nexus Weekly News Show. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus. Coming to you today from Hollywood, California, where I'm in town for an event here, and joined, as always, by my good friend and colleague who's in his New York home office, Todd Anderson. How are you doing, Todd?
I'm good, Peter. How are you?
Doing great. And joining us for the first time this week, we have Emily Mann. How are you doing, Emily?
I'm doing great. Thanks for having me.
Thanks for joining us.
Pleasure. Yes, indeed. So, before we start, why don't you just give the listeners and viewers just a 30-second summary of what you do?
Awesome. Yeah, absolutely. So I'm an investor at Redpoint Ventures. So we're a Bay Area fund with over $5 billion in AUM. I spend a lot of my time on the early growth side of the house. So think Series B plus. Investing across major categories as a firm, but myself, I'm focused on fintech as well as B2B software. So some of the companies we've worked with in the past include, Snowflake, Twilio, HashiCorp, Zendesk, and then on the fintech side, Stripe, Ramp, Wealthsimple, and a handful of others. And so excited to be talking about all the news that's been coming up this week.
Okay, well, let's kick it off. Thanks, Emily. So we're going to start with news that came out overnight here, and that is FTX. FTX in talks to raise up to $1 billion at a valuation of $32 billion. Now, of course, this is in talks. Nothing it looks like has closed yet. But I mean, if this is very impressive, because the thing that struck me when I was reading about this story is like the biggest comp for FTX is really Coinbase. They're the biggest publicly traded crypto exchange, and they're down 75% in the last so far in 2022. And this is going to be a flat round, and flat round's a new up round, right? So it's that is pretty impressive, I think, if they can pull this off. What are your thoughts?
Yeah, I would agree. That was probably the biggest thing coming out of the story. Whether or not it remains to be seen. Obviously, I think CNBC article that we have in there says terms could change, but the fact that it's not a big drop in valuation, I think, is a win. Because pretty much every other story you read of, except for a handful of companies, it seems like valuations are dropping 30, 40, 50, even 80% in some cases. So I think that's a big win for FTX, and clearly they've continued to do quite well regardless of what's going on with crypto prices. And if they do raise this money, it looks like they're going to continue to be on a buying spree.
Mm-hmm. Mm-hmm.
Yeah, maybe just to add an investor perspective on that. Redpoint's not an investor in FTX, although I have a lot of respect for what SBF has done with the company. Look, I think that they, as an investor, you always want to be in category defining companies, right? And I think FTX has very quickly emerged as one of those in the crypto space. While Coinbase is the closest comp and the public one so far, that has taken a bit of a beating on the markets. I think what you're seeing investors bet on here is really the rise of the institutional market. Right. I think Coinbase very much focused on the retail traders and users, and of course, therefore subject to the whimsies of retail traders and crypto prices. FTX is almost like beta exposure to the institutional crypto market as a whole, as they've kind of emerged as the central figure there. And I think, as you can see with some of the other stories that we're potentially going to cover today or have seen over the past couple of months, they've become kind of the linchpin across the ecosystem and community in terms of honestly, helping support through the winter times and consolidating a lot of troubled assets into their portfolio. And so I think that they see an opportunity now to go after what once was maybe a crowded market in some ways, and really solidify their position for when they believe the market comes back.
Yeah, one day. And I remember something we touched on this a few weeks back. There was a story, and I remember seeing that it's a really small percentage of the revenue comes from the retail consumer.
Really small.
FTX. Yeah. So that's a really, that's an interesting point. I hadn't really heard it put that way, but the beta for the institutional space, institutional crypto space. So that's an interesting way to put it. But anyway, let's move on. I want to talk about regular fintech now, and that is Stash. This was really interesting. Stash has created their own core banking system, and Stash sort of made a name for themselves with sort of this. I mean, they invented this. I think it's called the stock back or something, like where you basically get stock that your debit card rewards ends up buying stock in companies, and that was they've got many other things as well. They've got like lots of different savings accounts and different things like that. But they're not many. I mean, you've got Current doing their own core. You've got Stash now. I know. You've got the One that the company was bought by Walmart. But it's really most banks, most fintechs are not doing this. So interesting move by Stash, I would say.
I'd be curious if this lends itself to others beginning to look at the path, because Current obviously was way ahead of the curve doing it back in like 14 or 15, whenever Current started. You have Stash doing it. Obviously One is, and if you can afford the cost of doing it, which is a huge problem for a lot of fintechs, to sink the cost into it to then eventually get the cost savings of a core. Maybe it's worth it. I don't see it being a wide trend, but strategically for the right fintechs, it could make a lot of sense. We'll see if others go this path. I don't think a lot of companies can afford to do it right now, especially right now with the markets and the valuations and capital not as readily available.
Yeah, it's definitely a big undertaking, and one that can be pretty risky as well if things are, you don't make the right product decisions on the first day for how you want to structure your schemas, or the way that you want to build the products together. I know many companies in the past who have been burned trying to build their own ledgers, not even just saying, going as far to say a core, right? And so, but I do think that I can understand where Stash is coming from, because they've been sort of multi-product from early days, right? They were investing, they also did savings, and that's where I think you start to see a lot of the limitations of like a more traditional ledger or an outsourced core. In many cases, they tend to be very product-centric in ways, and can be hard to have an aggregated view across like the end user on multiple products. And so I wonder if this undertaking has to do with something around how they want to innovate on the customer experience.
Right. Quite possibly. Okay, so let's move on. I want to talk about Voyager. This is the bankrupt crypto lender.
Yeah, spicy one.
Yes. So this is reported this week in the Wall Street Journal and pretty much every other publication that covers crypto or finance. So this is a company that was worth $3.9 billion just a bit over a year ago. They're publicly traded on the Canadian Stock Exchange, and now they're apparently bids for their entire assets of $50 million. And apparently Binance has slightly higher bid than FTX, around 50 million. It's so kind of what's the word I'm looking for? It's a symbolic of the whole demise of some of these crypto lenders that they have gone. I don't know what percentage wise it is. It sounds like it's around 99% as far as values. So just and it's not a done deal yet. Apparently this is going to happen, they say, by the end of the month. But we'll find out who gets it, I'm sure, next week. But boy, what a fall.
I'm more curious about obviously the fall is bad, and the selling for a penny on the dollar is terrible. But, what are the lessons that, the next batch and the next cohort of crypto lenders learned from what Celsius and Voyager and others have done? Because I think that's the more interesting long-term story with this. Clearly, these some of the lenders made strategic decisions that were terrible, and they also had illiquid products that they were in on top of it all. And so, in the future, do crypto lenders learn the lesson that they need to and build a better product? Because I think there's a lot of appetite for it still.
Yep.
But clearly the way that these firms were set up and strategically made their decisions, it collapsed way too quickly.
Yes.
Totally. And to extend on that, lessons to be learned from, the traditional financial world too, right? I think a big part of what both Voyager and Celsius did wrong was they had this exposure to 3AC, which collapsed. And in many ways, that parallels what happened with Credit Suisse and Archegos, the hedge fund that ended up being over-levered. And, there wasn't a clear sense of, just exactly how much risk there was in the system. And so it's kind of funny to see the way that this has mirrored what has happened in traditional financial institutions. And so wonder if there end up being lessons carried across both.
Yeah, I mean, it's funny because you think after with the financial crisis, risk management would have, we would have better practices now that, I mean, like I look at some of the amounts of money that was lent to companies like Three Arrows Capital, and it's just insane to have 30, 40, 50% of your loan book on one unsecured loan. It's like,
right.
Yeah.
It's like it's like some of the retail the retail customers or retail traders that have like 99% of their money in like two things. Like you need to spread out your money so no one single point of failure. And it seems like that lesson just continues to be not learned across the board.
I would love to be on at FTX or at Binance here, because I actually don't really know what they're buying. Yeah, I know it's a huge discount, but like at this point, why not just let the company go under?
Yeah. Are they buying all these customers that they think are have value to them? Like, yeah, that's a good point.
Yeah. I have no idea how big their customer base is. It's probably in the millions. So you might be getting customers for, $30, $40, $50, something like that. But anyway, let's move on. Adyen is they started off really as a merchant processor in Europe, and now they're global, got a really big presence here in the US, payments processor, I should say. And they are now teaming up with Block to allow Cash App as a payment method. And I think this is actually huge. Cash App has 80 million active customers. And you can see that if you're like Adyen has huge numbers of companies, lots and lots of large companies use Adyen for their online checkout. And now instead of you'll have Visa, MasterCard, or you have credit cards, and you will have PayPal probably, and boom, Cash App. I think that because that's Cash App is being built on peer-to-peer payments, but the opportunity for business transactions, I think, is huge.
It is, and I think, Peter, we've talked about it a few times. Kind of these mini systems that are being created with Apple, with Block, with a few others, and I think it's interesting that this is the first one that goes outside the Square ecosystem.
Yep.
And to me, I think the bigger opportunity there is kind of that bridge and that connection beyond just the Square ecosystem and what that might mean. And to me, that's fascinating. It's I wonder if Apple sometime in the future looks at something similar, which is connecting outside the Apple ecosystem, because then you open up pretty much endless possibilities.
Mm-hmm.
Yeah, no, absolutely. I mean, I think this is also a great move on Adyen's part and part of their big push into physical retail as well, right? I think, which is a relatively recent thing for them. I mean, personally, the first time I've been a point of sale buff for a while now, but the first time I saw an Adyen terminal out in the wild was maybe a couple months ago at a winery. And so it's interesting to see how they're going about this, how this partnership will then position them when it comes to acquiring those merchants and competing with traditional acquirers like a WorldPay or Vodafone or whoever is in this space, and whether or not the Cash App piece will be a compelling differentiation for them. But yeah, I mean, I wonder, it in many ways feels a lot like what Venmo has tried to do with businesses. I don't know the latest on how successful that has been, but I think very much so going head to head in the future.
Yeah, that's the thing that, like, Adyen I interviewed the head of their operation. I don't know when it was, probably a couple of years now, where because it's on the large brands, and this is obviously Block is really great with small business, so I think there could be a lot of news as well. So anyway, let's move on to Nasdaq. I thought this was I was a little surprised by this story. So Nasdaq is basically, they've launched a new service, crypto custody service. They're calling it, Nasdaq Digital Assets, and they are basically going to do crypto custody, which I know they want to get involved in blockchain more deeply, because I feel like they're an exchange themselves, and that's a lot of what the technology is used for in many ways, is to sort of track all these complex transactions. So, but I wasn't expecting them to get into custody. So curious development, this one.
I mean, to me, it's definitely curious for Nasdaq, but it's another good signal for crypto overall. That traditional finance is getting deeper into the crypto ecosystem at a time when crypto prices have cratered. There's probably more high quality announcements from institutional or traditional finance than there probably ever has been before. Recently, there had BlackRock. Now you get Nasdaq. I mean, these are the traditional finance names. Recently, you had was it Schwab, Fidelity, and others launched EDX, their own crypto exchange. So I'm not sure what Nasdaq is after here. Maybe they're just getting a lot of interest and they want to service clients, and maybe they have other plans in the future. But I think it's still a pretty big win for the crypto ecosystem.
Mm-hmm.
Totally. Yeah, I was going to say that the biggest difference between this crypto cycle or run, whatever you want to call it, and the one that we saw, was it like 7 or 8 years ago now at this point, is just the level of institutional adoption that you've seen across the board, right? There's a real legitimization from businesses like Nasdaq and Blackstone getting into the ecosystem. And this is something that we've always debated here internally, is like, you almost have an arms race or a war or between, who's going to get there first, right? Is it the traditional fintechs, financial institutions that are then moving into crypto, like a Robinhood adding crypto trading, or is it going to be these crypto native companies that then bridge the gap to, winning the customer and expanding to traditional finance over time? And, who gets there first? And so I think this is just another example of that in the custody space.
Mm-hmm. Mm-hmm. For sure. Okay, so let's move on to the next story. This is a good old-fashioned fundraise. We have Sardine, Sardine.ai. They are basically an anti-fraud risk management type operation, fraud prevention, and they provide a lot of the infrastructure for that. I'm a big fan of this company. They're fairly new, but they've got lots and lots of big names in fintech and and some traditional banks as well that have
crypto too.
Yes, and crypto, exactly. And they just raised $51.5 million, led by Andreessen, and obviously marquee name. And it's it's no mention of valuation here, but they raised a $19.5 million round Series A earlier this year. But I'm guessing I just seem to think this is probably an up round, or at least down round. It's what it seemed like.
Yeah, I would. Peter, you broke up a little bit there, but if it was a really big up round, I think they probably would have mentioned it. It's probably somewhere, maybe a little up, maybe a little flat. But I think there was a couple of things in here that I thought was interesting. One is they've grown their client base about 3 times in less than a year, from the Series A to the Series B. And I thought the other thing I found fascinating was I think it was Sardine's CEO, Soups. I forget his last name, but 90% of fraud detected on Sardine's customers' platforms come from individuals who've already passed KYC. So it's this, they've already been KYC'd and then fraud happens. So it's not just, hey, we're going to stop the bad actors or stop fraud at the front door. It's what happens after someone's already been quote unquote KYC'd. And so I think solving that issue is probably a bigger challenge than just, hey, we're going to stop you at the front door. And so I think it's an interesting company, and good for them that they were able to raise capital so quickly.
Mm-hmm.
Yeah, big congratulations to the entire Sardine team. It's clear validation of what they've been building. I've been super impressed by Soups and his entire team. I've known them for a while now. And I think the space continues to be extremely compelling, right? Like, unfortunately or fortunately, fraudsters know that, the tools that exist today haven't really kept up for the switch to the digital era. And so there's, I can think of tons of times when I've talked to fintech founders who've been like, gosh, like the second we open up our wait list or start bringing customers on board, we just see this massive inflow of people trying to attack our platform or perform fraud. And so I think that it's great that they've built a system that is designed specifically for, the digital era in which people are transacting these days.
Indeed. Okay, we're going to move on to the CFPB and buy now, pay later. This is something that came out late last week, but it's been a really interesting story. We have, if you're a buy now, pay later platform, so this is the CFPB has you in their crosshairs. They've done some analysis. Like there's the 5 big platforms. I don't know all of them off the top of my head. Afterpay, obviously. You've got Affirm, you've got Klarna,
PayPal, Zip.
PayPal, Zip, yeah. So they've actually taken the raw data from these companies and done some analysis on it. This is not a survey. This is not a sample. They've taken the raw data and doing some really interesting analysis. So there is some changes coming for the buy now, pay later space. The CFPB is going to do something. And it's probably understandable because it's gone from pre-pandemic being this little niche thing that a few people did to being hundreds of billions of dollars of transactions now. So hopefully they don't overreach. Because consumers love this product. That's the bottom line. Consumers love it, and I hope that they will continue to be allowed to use it. But we'll see what's in store.
Yeah, I think, and the other side of the equation, in terms of the retail side, like the further they crack down on the Affirms of the world, the potential impact it does not only for the consumer, but this has probably helped sales immensely for companies. And I would hope that whatever guardrails they're putting in place, it doesn't, like you said, Peter, overreach and end up hurting some of the retail brands that might rely on this to get sales to 20% higher or 15% higher or whatever. And so I'm a little concerned about that. And the other part of it I thought was interesting. They talked about they're looking at the data mining and the acquisition of data in the financial space, and they're obviously concerned of either big tech or a handful of big players owning too much data which is very much a theme in Washington these days, which is too much data in the hands of too few. And so let's see what they come out with. Let's hope it's not overly dramatic.
Yeah, I think it was only a matter of time before we saw the regulators start to turn their attentions to this space, unfortunately. But I think the one thing that stuck out to me from the article in particular was that, traditional lenders have to do an affordability assessment. It doesn't seem like buy now, pay later providers have been, required to do that in the past. And many of them don't actually report these loans, quote unquote, back to the credit bureaus, right? And so I wonder how, that could create some adverse reactions, particularly in a macro climate like ours, where people might be getting overextended and, lenders do not have the full picture of their financial health. And in many cases, maybe there are, the CFPB is at the end of the day looking to protect consumers. I think that it's probably good that there's a little bit of scrutiny on some aspects as well.
Well, speaking of federal story is about Marcus, the Goldman Sachs unit that we talk about here on a regular basis. The Federal Reserve is looking into the operation of the consumer known as Marcus. And it's interesting because obviously the Federal Reserve, Goldman Sachs is a massive institution, systemically important. The Fed probably has a very close relationship there, and they are, there's nothing unusual about the Fed talking with Goldman Sachs, but this is specifically about the Marcus unit. And we don't know. It's a new review. We don't really know much of the details yet, other than it's happening.
Yeah, it's a bit strange, and they pretty much operate as a fintech under the Goldman umbrella. So I don't think there's anything overly special about how they operate right today. So let's hope it's not anything too bad that they unearth, or if it's just kind of oversight of what a non-consumer brand in Goldman, that they've jumped into consumer and they're just kind of being a bit careful.
Yeah, I guess regulating fintech is in vogue. It seems like that's what Washington's got their eyes set on now. Yeah, no, absolutely. I think that it's interesting that they're coming after Marcus specifically, which is part of the broader Goldman umbrella. I did see a report that came out a couple weeks ago that said that it was interesting to see that Marcus's card program, which is primarily driven by Apple Card, which is sort of their marquee customer today, was actually seeing near double the loss rates that you would see at a JP Morgan or a B of A on a similar card program. Like, part of that they attributed to, how young the book is as a whole and the program. But I just wonder, maybe there's some things that tie these two together.
Yeah, hopefully we'll all be revealed at some point. Yes. Okay, we got time. We got time for one more story here. I want to talk about Synctera. This is sort of this embedded finance type provider. They have an embedded product. So we obviously have. There's lots of fintech companies that do term loans, and there's a handful on the small business side that do line of credits as a service. But here is this is sort of consumer and the ultra small business sort of is the target here, where you can spin up a line of credit operation if you're a fintech that doesn't have that, and Synctera can power the whole thing for you. I thought this was an interesting development.
I'll give you a final comment, Emily. I know you know the embedded space well.
Oh, sure. No, I can go with it. Well, congrats to the team for an awesome launch. I think, embedded lending has been a space that, many platforms have been very actively pursuing. I'd be very curious to understand kind of how this looks on the back end, but it does seem like Synctera is on its way to looking like a headless bank almost, with both sides of the balance sheet. Now, I wonder if they're also getting the benefits like a traditional bank does in terms of cost of capital. But exciting to see kind of all the innovation that's happened in and around this ecosystem.
Yeah, and I just think final word here, the lending space, obviously, lending is what what we grew up with here at Fintech Nexus. We know it well. Now the fintech space is discovering lending. It feels like to me, lending is a highly profitable business if done well, and I think a lot of these companies are realizing that maybe just interchange is not going to be enough to kind of build a sustainable business, and lending has tremendous potential. So I expect this product to be popular as more and more of these fintechs start to get into lending. But anyway, that is all we have time for. Emily, it was great to have you on. Thank you so much.
Thanks, Emily.
Thanks as always to Todd. Quick reminder before we go, we have Merge is our Web3 meets fintech meets traditional banking event happening in London next month, October 17th and 18th. It's going to be a fantastic show. Hopefully, if your travels involve London, please come along to that. But with that, we'll wish you all a good afternoon. Have a good weekend, and we'll be back here same time next week. Bye.
Thank you.